Hawkish comments from the Federal Reserve members continued to make the headlines in the U.S. Yesterday's Susan Collins, Thomas Barkin and a new Fed Governor Adriana Kugler, all saying the same exact thing, that there is no hurry for the US to cut the interest rates when the economic data points at such a surprising and historical resilience to the modern times' most aggressive rate hikes. But knowing that the Fed is done hiking its rates and the expectation that the next move from the Fed will be a rate cut is enough to keep the market in a sweet spot. A delay in the timing of the first rate cut is even perceived as a good thing. The US economy is doing so well that there is no urge to cut the rates right away. And that's tant mieux for your corporate earnings. This is how the US economy shrugs off the latest commercial real estate worries that cost the New York Community Bancorp more than half of its value. And even though the worries jumped to Germany's Deutsche Fabriksbank, the stress is nowhere to be felt on the sovereign bond or index level. On the contrary, the US had a record-breaking auction for its 10-year bonds yesterday, where it sold $42 billion worth of notes at a lower than anticipated yield. The strong demand for the US 10-year papers hints that investors continue to binge buy the US 10-year papers while sitting patiently in the waiting room and watching the major US indices' record-breaking race to occupy themselves. You could think that the regional bank stress could bring the Fed to cut the rates earlier than otherwise, but that's not necessarily what we sense in the market today, so I am sticking to my rate cut expectation gun to explain why the US 10-year papers saw such a strong demand yesterday. In Germany, the 10-year bond yield didn't blink to Fabriksbank jitters. The DAX and the Stoxx 600 were down on Wednesday, but the declines remained too soft to hint at panic, while the S&P 500 renewed record and traded at a spitting distance from the 5,000 psychological mark. That's a powerful psychological milestone, mind you, and it could trigger some profit-taking due to the overbought market conditions and bubbling valuations. But the S&P 500's rally is backed by the anticipation of upcoming rate cuts and robust earnings. And sentiment in both yields and earnings remain supportive. In this respect, Disney followed in the footsteps of its happy tech peers yesterday and rose almost 7% in the after-hours trading after reporting better-than-expected earnings and issuing an upbeat profit outlook. All's well that ends well.